in the way some of the stocks have moved. Back to you guys in the studio.
A great conversation, Nigel and Dipan. Thank you very much for that. Let's also invite Jitendra Gohil, the head of India Equity Research at Credit Suisse Wealth Management, on the show now. Jitendra, afternoon, and thanks so much for joining in. Are you seeing any signs of fraud frenzy, which is typically associated when markets hit all-time high levels? And if that's not the case this time around, do you get the sense that perhaps markets have more legs to go on the way up?
Hi, Reema. Thank you for inviting me on your show. First of all, our investment committee has decided to stay neutral on India despite 110% valuation premium versus emerging market. That shows the confidence in underlying fundamentals. Definitely, the valuations for Indian equities is higher, but we are nowhere close to bubble kind of a territory. So while we are cognizant of the valuation is running a little higher, we believe that there are a lot of opportunities. And coming back to your questions, typically what we see is that the cash position with the mutual fund is at a little elevated level. If you look at the FPI holdings of Indian equities at around a decade low levels, so at least around 17.9% of FPI holding, which is 10-year low. And the retail investors haven't levered to the extent possible, but we haven't seen the froth in that segment as well. The VIX is falling down. So I don't think we are yet to a level where we have to be extremely worried about valuation match. And the second point also, one has to understand that while the markets looks all-time high, there's a lot of opportunities there. Look at some of the NBFCs, which are trading 52-week, closer to 52-week low. There are certain consumption-related stocks which are trading 52-week low. So I think there could be a good rotational opportunity within the sectors. And I think that's where we feel that still valuations are elevated, but still we are not extremely worried about the kind of froth in the market.
Right. Jitendra, sorry, NBFCs and some consumer names you mentioned, right? Good afternoon.
Yes.
I mean, without naming names, if you don't want to, can you be a bit more specific?
See, I think first thing is that there was a nice trade among the market participants that buy banks, sell NBFCs because the yields were going up. NBFCs actually depend a lot on wholesale borrowing, so that borrowing costs have gone up. So we think that sooner or later the interest rates globally will have to fall because we are looking at the Fed, which is going to slow down on their rate hiking cycle. So we have seen US interest rates have started falling, Indian interest rates have started falling. So I feel that some of the gold finance companies, for example, which have been trading at 52-week lows, I think those look little attractive to us from a valuation perspective. Secondly, I think some of the wholesale lenders to housing related segments, they have been beaten down badly. And I feel that there could be some kind of opportunity emerging as we remain positive on housing sector as a whole in the next few years or so. So it's a structural trend. We think that some of the NBFCs related to housing finance or related to developers should do well in the next few quarters or so.
Housing finance and gold loan NBFCs perhaps are looking attractive. Jitendra, do stay on. We've got a very important oil and gas story to track right now. We learned from sources that the Kirit Parikh committee will recommend complete liberalization of natural gas pricing by January 1st, 2026. Parikshit is here with the details. Parikshit?
Well, yes, sources telling us that the report is now in the final stages. It will be submitted to the government by the 30th of November in the next 2 days. The draft report has been circulated among all the members. It will be finally adopted tomorrow before being shared with the government. The big recommendation is complete liberalization of natural gas pricing by 1st January 2026. So there could be a roadmap there. At the same time, we believe that the committee has suggested price caps for APM gas, which includes ONGC and OIL. At the same time, the committee is not likely to suggest any change in prices of gas from difficult gas field. So while we're awaiting the contours, we believe that there will be a formula suggested for APM gas, and there will be no change in formula for consumers of piped gas as well. This is what sources are telling us. We will get more clarity on this in the days to come, but this report will finally go to the Union Cabinet, and that will take a final call on this.
Okay, Parikshit, thank you very much for that, and we'll sort of get back with Parikshit with more details, as he said, as he gets them. Jitendra, the big gainer today is Reliance Industries, some 3.5%, big contributor to gains. You heard my colleague Parikshit talking about what the Kirit Parikh committee is recommending on gas pricing. Any thoughts?
So from utility and oil and gas perspective, what we believe is that we are more tilted, our portfolio is more tilted towards gas utilities. We think that as the gas prices have started correcting globally, as well as the oil prices have started falling. So we are positive on consumers of gas and oil, whether it's tile companies or whether it's gas utilities, to some extent even fertilizer companies. These all companies that we are looking at, and we are a little bit overweight on this sector.
All right. Hi, Jitendra. Good afternoon. Thanks so much for speaking to us here on CNBC-TV18. Well, I'm just looking at your sectors of preference, and I find pharma in there. That's really not participated actually in the big run we have seen the last 5 years or so. Do you think most of the bad news now is factored in? Because some of these stocks on a forward multiple also are not looking very cheap. Your take?
Pharma, we went overweight a few months back, and our committee decided to maintain a little bit positive view on pharma sector. There are two reasons to it. One is generally during global slowdown, there is buying interest towards the defensive sectors, and pharma being one of the defensive sectors. We think that the valuations also not that expensive, and hence we are continue to. We maintain our positive view on pharma from a defensive side. Within the pharma sector, we think that the domestic pharma names are looking a little bit more attractive, and hence we continue to remain a little bit overweight on pharma sector because of its defensive appeal. Yeah.
All right, Jitendra, final question from my end before we let you go. Everyone's celebrating all-time highs. Unfortunately, some of those IPOs that came in November 2011, for many people who subscribed to that or bought it at some point of time, well, they'll be pulling out their hair. A lot of these stocks have come down considerably. Some of these businesses are very good, but the valuations are very elevated. At these prices, are some of these themes looking exciting?
This question keeps coming to us every time, and what we have been recommending to our investors to little bit stay away from this sector. One or two companies we do like, but we are extremely cautious about this sector because a lot of money has been already made before this IPOs came to the secondary market. So I think still we need for these companies to actually give us more guidance, more color in terms of how they are going to be profitable, and then probably it will look very attractive to us. But as of now, we are just observing these companies. We are not heavily invested in these all companies as of now.
All right, Jitendra, we'll take a quick break at this point, and we'll come back. As always, we'll get you a check on what dealing rooms are talking about in our segment, D-Street Chatter. We'll also get you by BTST trades with our technical expert in a bit from now. 30 minutes to go for market closing.